Hello everyone, welcome to module 3 titled Ratio Analysis. In the previous modules, we discussed about the financial statement analysis, their adversarials and some of the techniques. In this module, we will be dealing with one of the most celebrated technique of financial statement analysis, ratios. In essence, financial ratios which are used to unfold different causal relationship between and among variables with regard to the items disclosed in the financial statement by different companies all over the world. To start with, when we are talking about ratio, in essence ratio simply represents a relationship between two variables in such a way that we can express one variable in terms of another. That particular terminology has its origin mostly in mathematics or applied mathematics. But when you are going to apply this particular aspect in the domain of finance backed by the objective of financial decision making, it is essential to know what is meant by financial ratios. Financial ratios simply asserts the causal relationship which different financial variables exhibit with regard to the financial states of affairs of a company. We all know that different items which are finding a place within the ambit of financial statements, they are not to be studied in isolation. Rather, they are to be studied in totality by executing relationship so that we can have an explanation of different aspects of finance by using different variables either related to the income statement exclusively or related to balance sheets exclusively, or it is a blend of different items which are jointly explained in different financial statements like cash flow analysis, funds flow analysis, then the balance sheet and the income statement. To start with, when you are going to talk about financial ratio, and as a technique of financial analysis, it mostly asserts the relationship, and there are different ratios which have been used in congruence with different other financial variables in order to assert conclusions about different functional dimensions of a business, starting with whenever we are talking about short term orientation or near future aspects, we are using liquidity ratios. Whenever we are going to talk about the far future, we are using different solvency ratios. Whenever we are going to talk about the operational efficiency, we are going to make use of general profitability ratio. Whenever we are going to talk about the overall profitability and the ability of a company to generate profit, we are making use of overall profitability ratio. Moving further, when you are going to talk about the market valuation and all those related to different variables which are hailing from the market dynamics, we are applying the market valuation ratios, and ending of it, when you are going to talk about the relative efficiency with which different activities are getting executed, we are applying asset management ratios or efficiency ratios or asset movement ratios. There are different synonyms which have been used in the context of ratio analysis, and typically the financial ratios used to unfold the intricate and intermingled relationship that different financial variables exhibit and going to explain different aspects of the finance pertaining to a company. Moving further, when you are going to talk about financial ratio as one of the celebrated technique of financial statement analysis, we must delve into the significance with which it is going to serve the stakeholders community backed by varied interests and varied objectives. Now, to start with, it facilitates the establishment of relationship between financial variables. Just before, as I said, say for example, when you are going to talk about solvency, long term financial status, it is always imperative to establish a relationship between the two aspects of capitalization, the debt and the equity world. And whenever we are expressing both these things in terms of another, we are in a position to say what is the level of safety of the company in terms of finance, and what is the extent or what is the probability or likelihood of a company to go bankrupt or to be in a state of financial distress. So similarly, when we are talking about digging out the financial health or financial well-being of a company, it is always a bare necessity to establish a causal relationship, and that is one of the fundamental and formidable significance of financial ratios. Moving further, obviously financial statement analysis is backed by the very objective of appraising the financial performance. Now when we are talking about the significance of financial ratios as a technique, definitely it is going to contribute substantially to appraise and evaluate the financial performance in totality, as well as the financial performance related to different sub aspects of the financial states of affairs of a company. Moving further, financial ratios also facilitate the companies as well as the stakeholders to dig out the problem areas where different respective measures to unfold the problems as well as to adjust and avoid such problems are to be initiated at the end of the company. On the other hand, when you are going to talk about the users community, they are also equally inclined to unfold the problem areas, and accordingly they are going to make use of such things to finalize their decisions pertaining to varied objectives. Moving further, when you are going to talk about the financial data, mostly we know the financial data exhibits some of the typical characteristic of being a time series data. When you are going to talk about analyzing the time series data using financial ratios, it is always imperative to go for a comparative orientation either on a vertical approach or on a horizontal approach, which is leading to the horizontal as well as vertical analysis, which are most extensively used in the way the financial statements are read over a period of time or over a span of time. Moving further, when you are going to talk about the efficiency with which different functional activities have been adopted and executed by companies, there must be some ratios which are exclusively going to address and accommodate those aspects to evaluate the operational efficiency. And as just I mentioned, in the different genres of financial ratios, there is a specific subcategory of financial ratios which are exclusively encompassing different ratios which are going to dig out the operational efficiency. Moving further, all these things are ending up with planning and decision making process in such a way that we are in a position to arrive at informed and rational decisions. Without informed and rational decisions, it is pragmatically not feasible to develop strategies in this vulnerable and competitive world of business, where each and every peer is in a state as well as always on the verge of riding on others. To end up with the last point of significance, it facilitates credit worthiness and its evaluation. Again, there is a special class of ratios which are used in tandem in a supplementing and complementing way to unfold the credit worthiness of the business as well as in terms of finance, in terms of general aspect. Because when we are talking about credit worthiness, though it sounds to be absolutely financial in nature, but there are many other intervening variables which are playing its role in the context of appraising the credit worthiness. Now moving to the use of ratios as a technique or financial metrics to examine, to appraise or to evaluate the financial states of affairs of a company, but at the same time, irrespective of the fact that it is the most widely adopted and used technique, it is not free from deficiencies or loopholes. It is always imperative to know before using ratios what are its deficiencies, which are jotted down in this slide in the form of limitations of ratio analysis. To start with, we all know the financial ratios are going to make use of different ratios, but at the same time you cannot arrive at any conclusion if you are using ratios in an isolated manner or using a single ratio to talk about the long term solvency or to talk about the liquidity or to talk about the efficiency, to talk about appraising the financial distress to which a company is exposed to. So, that is one of the fundamental deficiency of ratio, that it is always expected that ratios must be used in combination. No single ratio leads to any robust conclusion. Then moving further, when you are going to talk about the deficiencies of ratio analysis, there prevails non-availability of adequate standards. There are certain standards available with regard to liquidity ratios, but they are otherwise interpreted as rule of thumbs, which simply implies that they are not going to hold equally robust under different circumstances, under different sectors and under different conditions. They are just benchmarks which are going to serve as a guide, but you cannot absolutely taking into consideration those rule of thumbs in order to arrive at a decision pertaining to different financial aspects of a company. So, hence in the world, though it is extensively used as a technique, but even today there is no standardized orientation with regard to the numerical measure pertaining to different financial ratios, which is going to suffice the fact that if the value of a particular ratio is this, it represents that the company is having very high credit worthiness, or if the value of a particular efficiency ratio is this times, then it simply represents that the level of efficiency is absolutely into its perfection. There is no such provision available in that context. That is why it is one of the again formidable deficiency. Moving further, when we are using financial ratios, we are more or less dependent on the financial information which are disclosed and disseminated through financial statements. But in the previous lectures, we have already had a discussion and deliberation on adversarials to financial statements, which simply talks about the loopholes of financial statements, loopholes which are prevalent in the domain of accounting, because mostly the companies are resorting to window dressing, they are resorting to deceptive disclosure, they are resorting to manipulations, they are resorting to intentional distortion of different facts related to finance in order to create a fantasy before the users community, and they can easily mislead the user so far as their decision making activities are concerned. But when we are talking about financial ratios, we have no other choice but to make use of those financial information or data which are getting disseminated in the financial statement, and more or less all these financial statements are deduced by the process of accounting which are universally applicable. So, again if we are coming out with some financial statement as a consequence to accounting which are faulty or inappropriate or inaccurate or undermining different financial variables, then obviously the financial ratios calculated using such variables are going to be not in a position to facilitate realistic decision making. Moving further, there prevails different techniques and methods when we are talking about the treatment of different items in the domain of accounting. Like say for example, the depreciation accounting, there are 12-13 different methods of charging depreciation in a financial year so far as their infrastructure or fixed assets are concerned. And we also know that if the method of depreciation is changing, the total quantum of depreciation which are going to be charged to profit and loss account, and it is going to be adjusted in the balance sheet so far as the adjusted book values of different fixed assets, definitely it is going to mislead, because there are companies who are using different depreciation policies in different assets so far as their calculation of depreciation is concerned. So, it is not at all advisable on the part of the companies to do so, but the companies usually resort to this particular manifestation. and accordingly when you are going to make use of those information, obviously the changes in accounting methods or the techniques is going to disrupt the very essence of use of financial ratios for the purpose of financial decision making. Moving further, there is heavy prevalence of window dressing vested with some premeditated objectives at the head of the companies or the corporate houses, because they would like to only disclose and disseminate information which are going to favor them and which is going to create a favorable picture before the stakeholders community who are using those financial information by heavily resorting to the act of window dressing. And as because we are having no choice but to make use of financial information which are generated out of the act of window dressing, again it is leading to a falsification of financial ratios and its calculation that leads to subdued financial decisions at the end of the users community. Moving further, obviously the analysts who are making use of financial ratios, they are backed by different hunches, different prejudice, and mostly the analysts are one way or the other dictated or governed by their prejudice, their hunches, and that reflects the personal bias while using and applying financial ratios to dig out different sub aspects of finance in the context of a company. The last loophole or the deficiency which is heavily influencing the use of financial ratio is the price level changes. Rarely we inculcate the price level changes to different financial information provided in the financial statement while we are calculating or quantifying different ratios. Obviously, we all know in the domain of finance and accounting how sensitive the time value of money is when we are talking about financial decisions related to future span of time. So, we cannot afford to ignore the price level changes, but the very fact is that the price level adjusted financial statements are not easily available, neither it is disseminated in the public domain. So, that is one of the inherent limitation of ratio when we are talking about its use and application. Moving further, when we are going to make use of ratios, what should be done in order to make the best out of it, which is leading to the very objective of facilitating financial decisions at the end of the stakeholders community. Now, looking at the limitations, we are there to adopt some precautions while making use of financial ratios as a technique of financial analysis leading to financial decisions. To start with, the reliability of financial information. We all know there is heavy prevalence of water in the financial information which dilutes the accuracy, reliability and authenticity of financial information which are used as inputs while calculating different financial ratios. So, it is imperative on the part of the users community to first dig out the level and the magnitude of the reliability of financial information which are disseminated in the financial statement. Without paying heed to the level of accuracy of financial information, if you are in a blind state going for the use of financial information given in financial statement, it may so happen that we are ending up with financial ratios which are obsolete, which are of no use whenever we are going to apply such ratios for the purpose of taking decisions or appraising the performance. Moving further, as an analyst or as a member of the stakeholders community backed by varied objectives, the most critical task at the end of the stakeholders community is to select different ratios to address the vested issue what they are interested for, and that is not an easy task, because when you are going to talk about, say for example, when you are going to talk about the short term liquidity, the ability of a company to meet its short term obligations, there are a bunch of ratios which are exclusively addressing that. But by using those liquidity ratios which are exclusively targeted towards short term financial position is not going to serve the purpose in a holistic manner. We are there to make a blend of all those ratios which are talking about the movement of current assets or the conversion of current assets into cash and the repayment aspects of current liabilities by consuming cash in a particular financial year in tandem with those bunches of liquidity ratios, then only you would be able to be in a position to realistically talk about the short term financial solvency of a particular company for the purpose of decision making. So, selection of ratio is very critical at the end of the stakeholders community, because many a times we are carrying one objective which is very complex and intricate, which cannot be addressed by using a particular group of ratios. So, whenever we are going to have those intricate issues which cannot be addressed outrightly by using a particular bunch of ratios, there is no way out but to go for a legitimate and logical combination of different ratios related to different aspects of finance in order to deduce robust conclusion. Moving further, use of standards or rule of thumbs. The users of financial ratios must be very cautious and have to adopt a cautionary approach when they are talking about rule of thumbs. Simply, say for example, one rule of thumb states with regard to current asset that the current asset, if it is 2 times the current liability, we can assert that the short term financial status of a company is good, but it is not always going to be correct, because in a financial year when we are generally talking about, it sounds very good, it sounds robust, but at the same time there are instances in the real world where the companies are having 5 times the current asset than their current liabilities, but they fail to pay salaries regularly to their employees at the end of every month. So, if you are going to go with the rule of thumbs outrightly in a blind state, it talks about 5 times. So, rule of thumb is saying that the liquidity status of the company is absolutely fantastic, it is much higher than the rule of thumb, but in the real world it is showing otherwise situation. The same company fails to pay the salary to their employees on a regular basis and in time. So, there are prevalences like this, what we may say that they are the antithesis in the real world or the gap that prevails between the theoretical aspect and the pragmatic orientation. So, you must be very careful when you are going to go for the use of rule of thumbs or standards which are to certain extent prescribed pertaining to certain ratios, not for all ratios, but for certain ratios there are certain rule of thumbs. But while using rule of thumbs for the purpose of commenting and concluding about the financial states of affairs, one has to have a very cautionary approach by paying heed to the realistic situation, then only we can end up in a state of robust conclusions. Moving further, the competencies of analysts. By merely knowing the formula to calculate the ratios, by merely digging out the causal relationship does not lead to robust conclusion with the use of financial ratios. One has to have that competency, one has to have those skills to unfold the intermingled relationships which are imbibed in those financial ratios which are not extrovert in nature, rather they are introvert. You are there to have sufficient understanding and exposure to unfold such intricacies, then only you can have the absolute outcomes of the use of ratio analysis. If you fail to do so, then one way or the other the financial ratios may not lead to such favorable outcomes so far as financial decision making is concerned. Then moving further, establishment of causal relationship. When you are going to talk about causal relationship, that is one of the essence of financial ratios. Causal relationship can be unidirectional, can be bidirectional. At times there prevails some relationship, but that does not at all lead to any causality. There may be the existence of fundamental forces which, as a consequence to which two ratios are related to each other, but we cannot always come to a conclusion that if you are calculating a ratio, there must be a causal relationship. So, one has to be very careful when making use of different financial variables and framing different ratios to unfold different financial aspects related to short term, related to long term, related to efficiency, related to profitability, related to valuation, related to leverage, whatever they may be. Whenever you are going to go with the causal relationship, you must be very careful, because the logical rationale of causal relationship must be absolutely robust and grounded, so that we can make use of such causal relationships not only to study the ratios or the financial states of affair in a retrospection, rather we can move further into the world of uncertainties by predicting different financial variables using such causality. Then moving further, after having an elementary idea about the significance, the essence and the concepts of financial ratios with the precautions which are supposed to be taken while using and applying financial ratios, now let us delve into different categories or the genres of financial ratios which are extensively used both in the academic as well as in the practitioner's world. To start with, there prevails liquidity ratio, which is essentially going to address whether the firm is in a position to meet all its current and near future financial obligations without any hiccup, without any problem, without any hindrances. For that, there are bunches of ratios which we would be discussing in the coming lectures. Then there comes solvency ratios, which is delving into the far future financial states of affairs by raising 49 questions whether the firm is having sufficient equity to pay off their debts, and so on and so forth. We will be dealing with the same in the subsequent schedules. Moving further, there comes general profitability ratio. It is more or less hovering around the protocol of digging out the operational efficiency, whether the business or the company is absolutely efficient in terms of executing different recurring activities in a day to day state, and whether it is in a position to generate profit which is going to be further used in its different dimensions. Then moving further, there comes the overall profitability ratio, which is the fourth subcategory of financial ratios. Here we are more or less going to address the profitability vis-a-vis the capital invested, like say for example return on investment, which is one of the financial ratio which is going to talk about the overall profitability. So, there are different ratios which are falling under the ambit of overall profitability ratio. Then the fifth subcategory is the valuation ratios, which are going to establish a relationship between the financial items and variables which are disclosed in the financial statement, and at the same time certain variables which are emanating from the market. And by having a blend of the variables emanating from the market and the variables emanating from the financial statements, we can be in a better position to talk about the valuation of a companies on a generic term. Then further, there is a subcategory which is the sixth one, which is going to delve into the efficiency ratios. It is essentially targeted towards digging out the operational efficiency as well as the movement of different assets during a particular financial year, so that we are in a position to manage and address all these issues in the best possible manner. Now, with this we are ending up with the first lecture on ratio analysis. Thanks for patient hearing. Thank you.